13.2% earnings growth, year over year. Q1 2026, the sixth consecutive double-digit quarter for the S&P 500. $629.3 billion in total estimated earnings, delivered during a live tariff war, oil price swings, and conflict active on two fronts. Not a soft beat. 6 consecutive quarters above 10% growth in the most hostile macro environment since 2022. Rising input costs, trade uncertainty, a strong dollar hitting multinationals. The headwind list was real. For 6 straight quarters, American corporate earnings have not cared. The numbers keep landing above forecast, above the prior year, and above what the global picture would suggest is possible. If you want to see the real numbers behind the headlines, subscribe to the Data Desk and hit the bell so you never miss a breakdown. 6 consecutive double-digit quarters. The last comparable streak ran through the post-COVID reopening when low base comparisons did most of the arithmetic. That tailwind does not exist here. These are clean numbers against normal year-over-year baselines. JPMorgan opened Q1 2026 earnings season on April 14th. Net income, $16.5 billion, up 13% year over year. Revenue, $50.54 billion, up 10%. The largest U.S. bank by assets, first to report. Jamie Dimon did not declare victory. His statement flagged trade policy as a material headwind for 2026. Record income on page 1. Macro warnings on page 2. That tension defined Q1 2026 earnings season from day one. Before this season opened, analyst estimates for S&P 500 Q1 growth were positive, but well short of where results are landing. That gap traces to 3 years of cost reduction across corporate America. It started in 2022, when inflation forced every CFO to get serious about margins. Headcount, supply chain, energy exposure, quiet, unglamorous work. It is showing up in income statements now. $14.6 billion in Q1 2025. $16.5 billion in Q1 2026. That is a $1.9 billion year-over-year net income jump at the single largest bank in the United States in 1 quarter. That chart is one company. The S&P 500 has 500, and the index is weighted. When the largest names grow fastest, the headline number moves fastest. Right now, 3 sectors are doing most of the lifting. One of them is posting returns that look less like quarterly earnings and more like a structural shift. Energy is the counterintuitive part of this story. Crude oil swings cut into top-line revenue this quarter, but cost discipline from prior cycles held margins, and energy still contributed positively to 13.2% index growth. Technology infrastructure is not cooling off. AI-driven capital expenditure across major cloud and semiconductor companies hit new highs in Q1 2026. That spending is converting directly into sector earnings upstream. 6 straight quarters. $629.3 billion in Q1 alone. 13.2% growth, the highest reading of the entire streak. JPMorgan alone posted $16.5 billion in net income, while its CEO put trade warnings in the same statement. The numbers are not in question. Where they come from is. This is not 500 companies all moving together. 3 sectors are carrying this index, and one of them is posting results that are quietly reshaping what American corporate earnings look like at scale. That breakdown is next. The headline number is 13.2%, but that is an average. Averages hide what is happening underneath. The S&P 500 has 11 sectors. They did not all grow at 13.2%. 3 of them are running so far ahead that the index level figure understates the real story. And one posted a Q1 number that makes you read it twice. Information technology, plus 45% earnings growth year over year, Q1 2026, per FactSet. In a single quarter, more than 3 times the index-wide growth rate, while the rest of corporate America was managing a tariff dispute, an oil shock, and a strong dollar. The sector did not catch analysts off guard. In the 3 months before Q1 reporting opened, analysts raised the IT consensus estimate by 1,000 basis points. Models had already priced in what AI infrastructure spending was doing upstream. Then companies cleared those revised estimates anyway. 33 IT companies issued positive EPS guidance before Q1, the highest count of any sector in the S&P 500. 45%, 24.2%, 15.1%. Information technology, materials, financials, the 3 sectors leading Q1 2026. The index-wide blended growth of 13.2% sits well below all 3. The gap between IT and the overall index is not a rounding error. It is a structural split. Look inside the 45% number. It is not spread evenly across IT. It concentrates in semiconductors, the industry physically supplying the AI build-out. NVIDIA is the single largest contributor to S&P 500 earnings growth in Q1 2026 across all 500 companies. Remove NVIDIA from the Magnificent Seven, and that group's projected growth drops from 22.8% to 6.4%. One company, that much difference. And yet, the other 493 companies in the index are still at 10.1%, double-digit on their own. This is not 7 companies carrying 493 flat ones. The base is growing independently. Semiconductors drive the bulk of IT's 45%. The AI hardware build-out, data centers, accelerators, high bandwidth memory, converts into earnings at companies making the physical equipment. That spending is not pulling back in 2026. Communication services posted the largest positive aggregate earnings surprise of any sector in Q1 2026. Netflix beat its EPS estimate by 62%, $1.23 against a 76-cent forecast. Revenue, $12.25 billion, up 16.2% year over year. Zoom out from the sector breakdown to the beat rate, and the picture gets broader still. As of April 17, 88% of S&P 500 companies that had reported Q1 results came in above analyst estimates. The 5-year average is 78%. The 10-year average is 76%. And they are not just beating, they are beating by more. Average upside surprise, 10.8%. 5-year average, 7.3%. Both metrics historically elevated. That matters because the blended 13.2% rate is still a live number. Q4 2025 entered earnings season at a forecast of 8.3%. It closed at 13.9%, a 5.6-point gap. Q1 2026 is running the same pattern. There is one sector with a major block of results still to come, and its forward guidance may say more about the next 3 quarters than any other data point this season. That sector is next. The story running underneath Q1 2026 earnings is not the growth rates, it is margin. 3 years of cost restructuring, headcount in 2022, supply chain in 2023, pricing discipline through 2024, is now converting into income statement results at index scale. The work was quiet, unglamorous. The output is now visible. 6 S&P 500 sectors are reporting net profit margins above their 5-year averages in Q1 2026. Information technology leads, 28.9% net margin against a 5-year average of 25%. The index-wide Q1 margin, 13.2%, is above the 12.8% from a year ago and above the 5-year average of 12.2%. 4 sectors are reporting year-over-year margin improvement this quarter. IT is one of them. That margin is the foundation of where the financial sector just went in 1 reporting week. and it sets the context for the two sectors that are in decline. The S&P 500 net profit margin for Q1 2026 is 13.2%, above the 12.8% from a year ago, above the 5-year average of 12.2%. American companies are not just growing revenue, they are keeping more of it. Financials entered Q1 2026 with a projected growth rate of 15%. As major bank results came in during the week of April 14th, the blended sector rate moved to 19.7% in one reporting week. The beats explain the move. JPMorgan Chase, $5.94 EPS versus a $5.47 estimate. Citigroup, $3.06 versus $2.65. Morgan Stanley, $3.43 versus $3.02. Bank of America, $1.11 versus $1.01. Bank of New York Mellon, $2.24 versus $1.96. In aggregate, Financials is coming in 7.8% above Q1 estimates, the fourth largest positive earnings surprise of any sector in the index. The Financials forward guidance is where Q1 2026 lives. JPMorgan's letter to shareholders flagged trade policy as a material headwind for the remainder of 2026. The largest quarterly bank result in company history in the same document as a macro warning. Not every sector is in positive territory. The energy sector tells the most volatile story of the quarter. Energy entered Q1 2026 at an estimated growth rate of plus 8.5%. By April 3rd, lifted by higher oil prices, that estimate had risen to plus 12.9%. Then ExxonMobil revised its guidance. By April 17th, the blended growth rate for the energy sector is minus 13.1%, a 21-point swing in 6 weeks, driven by one company's revision. The energy sector tracked 12.9% growth as of April 3rd. WTI crude hit $101.38 intraday during Q1. The Q1 average price, $72.67, was only 1.8% above Q1 2025. ExxonMobil's guidance revision brought the sector's blended Q1 rate to negative 13.1%. Healthcare at negative 9.8% is the headline number. Remove Merck's one-time acquisition charge, and the sector is at 2.8%. One company's balance sheet decision is moving an entire sector's Q1 growth rate. The underlying demand in healthcare is not declining. Two sectors in decline, both with specific one-quarter explanations. Neither tells a story about the health of the broader index. Look at where margins go from here. Q1 2026, 13.2%. Q2 forecast, 13.8%. Q3 and Q4, 14.2% each. FactSet is projecting a full year 2026 net profit margin of 13.9%, the highest annual reading since the firm began tracking this metric in 2008, the highest in the data set. That forecast is built on what the cost base of American companies looks like after 3 years of structural work. The same discipline that delivered 13.2% in Q1 is what analysts are modeling into Q3 and Q4. Part 4 is where that margin meets the full year forecast and what it means for the argument that this earnings streak has run out of room. The bear case on this streak has been the same for 6 quarters. Tariffs will compress margins. Geopolitical risk will kill demand. The bill is coming. The bill has not arrived. FactSet is projecting Q2 2026 earnings growth at 20.1%, Q3 at 22.2%, Q4 at 19.9%. Full year 2026, 18%. The 10-year average annual earnings growth rate for the S&P 500 is 8.6%. The 2026 projection is more than double that on clean comparisons against the 2025 in which the index already delivered 13.2%. If 2026 closes at 18%, it marks the third consecutive year of double-digit earnings growth and the sixth straight year of positive growth overall. Q1 2026, 13.2%. Q2, 20.1%. Q3, 22.2%. Q4, 19.9%. Full year at 18%, more than double the 10-year average of 8.6%. What analysts are modeling now against the headwinds that were supposed to stop this streak 4 quarters ago. Look inside the 18% forecast. For CY 2026, FactSet projects 24.6% earnings growth for the Magnificent Seven and 15.9% for the other 493, up from 9.4% in CY 2025. The rest of the index is accelerating, not just the names at the top. Q1 2026 revenue growth, 9.7%, the highest since Q3 2022. Lower cost base, growing top line. Both holding simultaneously is what the 13.9% full-year net profit margin projection is built on. The 15.9% projected CY 2026 growth for the other 493 S&P 500 companies is the number the Magnificent Seven headlines obscure, up from 9.4% in CY 2025. When the base of the index accelerates like that, this is not a story about 7 companies. The forward PE ratio for the S&P 500 as of April 17th is 20.9, above the 5-year average of 19.9 and the 10-year average of 18.9. Not a cheap market. But it is a market pricing 18% annual earnings growth against a structural margin floor that is rising quarter by quarter. That is a different kind of premium than speculation. The third consecutive year of double-digit S&P 500 earnings growth. That is what CY 2026 looks like if projections hold. 18% on top of 13.2% in 2025. The 6th straight year of positive growth overall. Clean comparisons. For an index that was supposed to crack under pressure, the numbers keep not cracking. 6 consecutive double-digit quarters. $629.3 billion in Q1 alone. 13.2% growth while oil hit $100 and record bank results arrived with macro warnings in the same letter. 18% projected full-year growth, more than double the 10-year average of 8.6%, on the highest annual net profit margin the S&P 500 has produced since FactSet began tracking it in 2008. The data does not support the narrative that American companies are running out of room. What story should we break down next? Drop it in the comments, and we will see you in the next data file.